We're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show. This is a special edition. What the heck is going on with insurance? We heard the community speak. You were wondering what's going on with insurance rates. We are answering. I'm your host, Pablo Gonzalez. My usual great co-host, GC, is off in Vancouver, enjoying some time with his family. So we brought in the number one person that I rely on for any insurance thing. She is the founder of Ricci Insurance Group. She is JWB's preferred insurance partner. She is a super connector here in the land of Jacksonville, Florida, real estate investing. The person that introduced me to Greg herself, she introduced us. My past original dance coach in college, one of my best friends, Whitney Ricci. Say hello, Whit.
Oh, very good. I need to just take Pablo around and just, have him introduce me into every room, because that's a unique resume, though, that you in this group. That
you were the first person to ever say, "Hey, do you want to go hang out at my thing and be a hype man?"
Yeah, it's true. I said, and I invited him on my calendar invite that said Whitney's hype man, because I just wanted to make sure that everybody on my sponsored hole at the JWB golf tournament was having a good time. And Greg Cohen was doing kung fu, kicking over a giant Jenga, and the rest is history.
Yeah, that's what sealed the deal for this show. And with us, as always, is our community manager, doing anything that you need in the chat, helping you understand the stuff and getting you the content and connecting the people. We call her MTM because she brings us the moments that matter. And because her name is Madison the Magnificent. Say hello, Madison.
Hey, everybody.
And if you are joining us on YouTube or on a podcast, first of all, if you're listening on the podcast, you're probably going to want to check out the YouTube stream, because one of us is in a flow costume from Progressive. And hopefully, Progressive, if you see this.
It's not me.
You can tweet this out and have it go viral. But the best way to enjoy the show is to go to nyais.com, sign up, put it on your calendar, show up one of these days for the live version here that we do on Tuesdays and Thursdays, and be part of a little tradition. Do you know what it's called? Whitney, do you know what the tradition at the beginning of the show is called?
If I get it wrong, I'm going to be embarrassed. But
it's called the roll call, Whitney. All right,
the roll call.
Danny Davis with a guten tag. We got John Henning, our leadoff hitter, batting second today with a good afternoon. We got Tony D in the house. Anthony Dida saying hi, everybody. We got the touchdown maker, Shannon Baker, in the house. We got Pedro Nacianciano checking in from Jersey. Pedro, good to have you. We got Joe Bussey checking in from the West Coast. We got former stand-up paddleboarding world champion Sean Pointer, real estate investor, in the house. Not former, past, whatever. 2019 world champion. He's a professional surfer. People. We got Nadeem Shah from the West Coast with his trademark good afternoon, good morning all. We got Big Papa Jay Cohen. We love when Big Papa calls in. GC's dad, Jay Cohen. We got Leslie Wilson, the real estate maven from Denver, Colorado, checking in with us. We got Leo Faraganan. Good morning from the Sunny Bay area, California, rocking on. We got the man that everybody knows. He's back. Noah Randari checking in from California. Who else? We got the ringmaster, Andrew Barnhill, ringmaster of the Not Your Average Investor community. We got Tuesday star, fiduciary financial advisor extraordinaire, Kelly Barenbaum, in the house. We got the second family of the Not Your Average Investor show, Gary and Rosalind Riley, the regulars, checking in from Marietta, California. Who we got? We got Rich Ritchie. You ever heard of that guy, Whit?
We'll keep him.
You're welcome for that. We got Eddie Harris from Hotlanta. I introduced Whitney to her husband. No big deal. We got Eddie Harris from Hotlanta checking in as well. We got Pop Pop in the house, Whitney's dad, one of the original super fans of the show. Good to have you back, Pop Pop. I see why you're here. Hervé Francois in the house with a What Up JWB fam. We got Avianca Manning representing Team Richie in the house. We got Marilyn Cotterman from Homosassa, Florida. You know what goes down in Homosassa, Florida, Whitney?
Manatees.
This is where people swim with the manatees. Everybody knows it's world famous. We got
I went to Manatee High School, so I know that.
That's right. We got Tim Horvath, commercial real estate property management, Bold City Commercial out here representing good friend of the show, good friend of mine and Wits. Raj Bantu, right along Raj, my partner for What Happened to Pablo. Raj, what happened to me is that I'm a clown. So when Whitney puts a flow costume, I call her the original Flo from Progressive. So she decided to dare me to do this. And
no, hold on. There was no dare, Pablo. You did this on your own accord.
It was an unspoken dare, which you put.
I gifted this to you. I put the costume at your microphone. And this was all you.
You're right. We got the first family of the Not Your Average Investor show in the house. Ken and Carolyn Moline checking in from Los Altos. We salute you, first family. We got Amy Matthews is back. Amy, good to have you. We got Aaron O'Neill into the lights, my favorite name to pronounce, in the chat. Who else we got? We got Billy Green from the mountains of Colorado, the chilly mountains from Colorado. That's making me hungry, Billy Green. Who else we got? Robin Schofield. Robin from New Hampshire. Robin, I think I've seen your name before, but good to have you back. Marianne Cambe saying hi from the Ricci team as well. David Verhage from Lafayette, Louisiana. David, let me know how badly I butchered your name, but welcome to the show. That's a new name. Alejandro Diaz, Alex Diaz from Tampa, Florida. Alex, good to have you. I think a new name as well. Welcome to the show. Good to have you. Gerald Schwartz back in the house. Brian McKay from Woodstock, Georgia. Yuri Mashkovich. Man, we got a lot of folks. We got the fairy godmother, Jen Filzen in the house. I think I'm going to just be calling out names. Sergio Prieto, go Gators. Bradley Goodson. All right, we're just going to kick this thing off. Ready? Oh, we got Greg number one, Greg Stone from New Jersey as well. Good to have you here as well. Pamela Myers from Washington State. Welcome to the show.
There's a lot. My team's having a watch party, so I want to say, hey, they're at the office watching together.
Wait, I'm out of breath, but I feel like you've been out of breath for the last year or so, because there's been all this stuff that's been happening in the insurance world. You've been knee deep in all of it, in the activism and the front lines, fighting for your clients, fighting for JWB investors. Can you give us a summary of what's been happening over the past couple of years? And then, and then we'll go into kind of the latest update.
Okay, sure. And I want to add, I talk about this a lot. I care about this a lot. I know a lot about this, but I'm not a lobbyist. I don't have any formal training in this. I am just an insurance agent who does all of the insurance for all of my friends and family and my family's friends and friends' family, et cetera. And is everything okay?
I forgot my favorite segment of the show, Whit. It's when Madison shares good news. Madison, you want to share some good news?
Well, the good news was that Whitney was here and she was getting right into it, but I can share some too. So everybody, some good news. I shared it last week. I'll make it quick so we can really get into it because we got a lot of people here waiting to hear you talk. But the golf tournament cocktail hour is open to the public. So we are selling tickets. There are only 50 tickets to be sold, and we want to give our community first come, first serve. So each ticket is $100. It gets you in the door after the tournament. It starts around 1:30 to come hang out with us, meet the team, meet the golfers, network. There's going to be a lot of really cool people, a lot of fun, food, drinks, all that good stuff. Tickets are $100 and you can purchase them at www.jwrealestate.com/fun.
Thank you, Madison. I'm sorry that I got too excited. It's this wig is getting inside of my brain and I don't know what to do with it. That is really good news because the golf tournament, like you said, is the place where it wasn't where you introduced me to Greg, but it's where, as the Hype Man thing, the whole show came from. We've always been wanting to expand the tent, let more people come. So
that's very cool.
That's good news. Thanks.
So will Greg be kung fu kicking over a tower of giant Jenga?
TBD.
One can only hope.
That was the magic that happened at the first connection of Greg and Pablo at the tournament. So.
What's the date of the tournament, Madison?
May 1st.
May 1st.
It's a Monday.
Love it. It has been confirmed that the Filzens are coming. The fairy godmother family is coming. So Madison, that's good news. Thank you very much.
Of course.
All right, Whit.
Great.
Well, I interrupted you before. Go ahead.
Oh, it's not first time. I'm sure it won't be the last time. But anyway, just kidding. I just want to make sure that you guys know that, I'm not a professor on this, but this is just something that's become increasingly important. And one of our core values is to be worthy of our clients' business. And that used to mean making sure that we had appointments with all of the best carriers and making sure that we understood all the policy contract language to get people the best value on their insurance. And when things started to go a little sideways, and it's been more than, I've been making this shift in our business model towards more advocacy back to 2020. As I pulled these PowerPoint slides, I'm like, oh gosh, I've been doing this a long time. But it became evident to me that if I am not advocating for my clients and talking to people who can fix this on a legislative level, because we're going to get into this a little bit more, but this is a broken system. This isn't just, one little one-off thing. Now, and there's good news at the end of this, so stand by because it's been a long road. But boy, this bill that was just signed into law, they're calling it the biggest piece of tort reform in Florida's history. It's huge. So if you want me to just dive in, Pablo, to talk about what happened, how did we get here?
Yeah. Why don't you tell us, okay. Basically the life of a real estate investor over the last year or so has seen
Right. They're seeing the end, the consequence.
Correct.
And it's always really well received when we do a little bit of a history lesson and we go back to say, okay, how did this happen? And don't worry, I'm not going to keep everybody here for 3 hours. I'm actually hiding in a conference room. I'm in a meeting myself right now. But I'm like, well, please, I'll be right back. But let me start to what exactly happened here. So all the way back to 2005, there was a claim in Naples, Florida. The guy's name was Jeff Sebo. It was on a super custom home, like an $8 million home. And the home was built poorly. The home leaked. They didn't seal it correctly. Well, then came along Hurricane Wilma and the house leaked again. So did it leak from the storm? Did it leak because it was built poorly? It was one of these gray areas. So Jeff Sebo didn't even sue his insurance companies, didn't even name them to the suit until 2008. So it wasn't like his story the whole time was, I'm mad at my insurance company. He was suing everybody. He was suing all the builders, all this stuff. So when this went to Florida court, it went back and forth and back and forth, and it brought up the issue of concurrent cause of loss. So when two things happen at the same time, one covered by insurance, which in this case is a hurricane, one not covered by insurance, which is your builder doing a crappy job of building your house, is insurance supposed to pay? And prior to this case, it was always, if the first thing is covered by insurance, then insurance has to pay. But if the first thing is not covered by insurance, then they should only have to pay for the part that's covered. So for example, if you have a policy, we see a lot that we have clients that will choose to self-insure the portion for water. But if wind blows a tree onto your house and water comes in and it breaks the pipe and there's resulting water damage from the first thing that happened, which was caused by wind, they're going to cover all of it. That hasn't changed. I mean, they still will cover all of it. There's something that's been peeled back. But the main issue of what happened here is this accidentally opened up a loophole for when wear and tear happens. And spoiler alert, we're going right to the roofs. When there's wear and tear that's happened on an entire roof because it's old, which is definitely going to happen. And then maybe there's one or two shingles that are damaged by wind, which is a covered peril. What happens is by policy contract language, that's supposed to be, we'll cover what's actually been damaged by the storm. But because of the Sebo case, it's a loophole. It makes it difficult for an insurance company to win in court. Another surprise, insurance companies historically don't make you don't feel bad for them. When you go to court, you feel bad for the homeowner, the Florida homeowner, which again, Let's talk about, Jeff. We're talking about an $8 million custom home in Naples here. This is not some poor little, homeowner. But they settled it after going back and forth on appeal. They did require that the insurance company pay Jeff Sebo. So now we have step one, concurrent cause of loss. It makes it easy to win in court to make the insurance company pay for something that was the policy contract is not a warranty. It was not designed to cover it. They didn't collect premium for. That kind of sat there. Then fast forward to 2017, we had the Joyce case, which was actually a couple in St. Augustine, Florida, right in our backyard. And it was a relatively small case. It was only about $9,000. They had a water damage claim. The insurance company denied it because when they pulled the file, they realized that this client had actually had multiple prior claims and wasn't eligible to have insurance with that company to begin with. So they canceled the policy for material misrepresentation, refunded back all the premium, didn't pay the claim. Well, this was a very compelling plaintiff. This is an older couple. I don't know exactly how old, but they found an attorney. They sued. There were some things that were gray about this. It was gray enough that the insurance company probably should have paid from the beginning. So they did. They paid. This case is not remarkable for that reason. This case is remarkable because of the fact that after they paid that $9,000 whatever claim, the attorney turned over $90-something thousand of attorney fees. And the attorney said, I've added a fee multiplier because this case was rare and unusual and it took me more work. And so because of, I think that I should be paid more for the work that I did on this case. Well, we know now, definitely, there is nothing rare and unusual about suing your insurance company in Florida. So that case went back and forth and back and forth, same thing in the Florida Supreme Courts. And at the end of the day, with the spirit of the courts feeling like she did work really hard, we feel that the insurance company should have paid. We're going to award her that money. And what they did is they opened up Pandora's box. And now the floodgates are open for it's easy and it's super lucrative to sue insurance companies for things that shouldn't have originally been covered. Throw in the last piece of the puzzle here, and we have COVID quarantine when everybody is quarantining at home. And we have entire neighborhoods because of Florida's growth, all these newer homes that are kind of aging out from their first roofs. And it set up a system for, we call them, here's my slide, the Cobra farmers. If you know the Cobra effect, where you have a well-intended, these court cases, they were all well-intended, but they had an unintended consequence, which was, ended up being to the detriment of the consumer. But they set up this formula where you have these door knocking roofers or contractors who are feeding into this system where it's too easy and too lucrative to sue insurance companies. So yay, this tort reform already signed into bill has fixed the system. Holly freaking hallelujah. Is that, what do you call the sizzle reel? Put that in the sizzle reel. Holly freaking hallelujah. They have fixed the system. And I want it to be very clear about why I am wildly optimistic about this. And we'll go through the legislation, but I really needed to add that backstory because people are always like, oh, that makes so much sense. That's why you can have a carrier that can go from A-rated to insolvent. And people are like, how does that happen? This is unprecedented. Well, that's how. So there's all kinds of stuff to reduce the likelihood, ideally eliminate the possibility of that happening in the future. That may be a little in the weeds for us to get into in this conversation, but I'm glad to talk about that as a follow-up. But it's good stuff. It's really good stuff. But we have been in a similar situation in our country before where there was issues with sinkholes. And it was a similar thing. The burden was on the insurance company to prove that there wasn't a sinkhole. And that's really hard to do. So you had a lot of similar bad actors feeding billboard attorneys, taking advantage of the situation. And what did our legislature do? They passed a new amendment or a new precedent that defined it instead of as a sinkhole. It's now called Florida Catastrophic Ground Collapse Coverage. And now to file a claim for a sinkhole occurring and damaging your property has to be damaged. You have to be able to see it with the naked eye. There are like these very common sense things that should have been included all the time. Once they pass that, now you never hear about sinkhole claims in Florida anymore. It was a system that had some issues. They fixed it and we moved forward. So we're feeling great about that. Great about the course correction that we've put on, that we've been reset on.
Cool. Great.
How many words a minute did I just get in there? Was that like,
I'm rarely outpaced in rate of speech on the show, but you're doing a great job, Whit. So just quick recap. Whit, by the way, one of my favorite things about you is you're a great storyteller. So I appreciate the whole backstory. Essentially, the shortened version is that there was a situation that caused a legal precedent that then opened up a loophole where incentives got all messed up, right? And all of a sudden, roofers could find something small wrong with a roof, tell a homeowner that because this is here, there is this legal thing where we can just go get an attorney to threaten an insurance company, and you can get a new roof for free on your insurance company. And that behavior led to incentivizing,
frivolous lawsuits, excessive claims,
which then made insurance companies have to adjust their rate because of the mathematics that they need to do. And that started happening for a long time. And then a couple of noble folks like yourself went up to the Capitol and, raised the issue with their lawmakers. They have rethought the issue and they passed some new legislation that has taken away that thing, the thing at the center of this incentive package that is causing this behavior that is not helping consumers. Yes. They've taken that away, and the future looks brighter than the past. The past being these elevated insurance rates. Now we have some hope that stuff that is elevating the insurance rates because of that will start to temper and go down in the future, right?
We are very optimistic about that. It's going to take a little bit of time. We had a hurricane last year. Yep. And so, there is the real risk that insurance companies, and this is not just in America. I mean, the reinsurance market is a global market. We have earthquakes in other parts of the world. Like if there wasn't risk, then there wouldn't be insurance. So it's a little bit bigger than that. But yes, we do feel that we're on the correct track for course correction and for making Florida a more friendly marketplace for insurance companies to want to do business, because the soonest way that we're going to see any type of a rate relief is going to be competition. And carriers now are this bill was only signed into law, by the way, 1 hour after it was passed through the House and the Senate. And if you want to have your mind blown, in the week leading up to the governor signing it, there were almost 100,000 lawsuits filed to try and get in under the radar before they changed it. And that's what he signed it within an hour because they didn't want it to go till Monday. It was this whole dramatic thing. But we have seen exceptions given by underwriters on things that just a month ago they would have said no on. And a lot of them, the kind of common sense, put human eyes on it. We've got a client who's got a home in Florida and they've had a claim on their primary residence in Michigan. Can we still write this, this policy in Florida and not have to, sell them a very expensive policy? And now they're saying yes, which is great. There are new discounts that are coming out also. That's been a result of some of the legislation over the last year, the agreement to binding arbitration, which says, hey, I'm not trying to make my insurance claim be the jackpot. I just want to be treated fairly and paid 100% of what I'm owed. So you don't have to worry about me suing you. So don't charge me that extra premium that you're calculating. We call it the tort tax. You're insuring against the risk that your client is going to sue you and it's going to be very expensive. If a client agrees to not do that, now some of the carriers are going to be discounts for that, which I think is fantastic. You're saying, hey, I'm not the problem, then don't blame me and charge me for the problem.
Yeah. Yeah. Okay. So that sounds like a brighter future than the past, right? Can
I tell you about some of the specific stuff in the legislation?
Yeah. Why don't you tell us some of the specific stuff in the legislature? Don't put us to sleep.
I won't put you to sleep, but this is the stuff, part of what's been incredibly rewarding for me and worth it for me to do this stuff. I mean, I'm becoming more comfortable with this. And when I'm talking to somebody who's dressed as Flo, I would even go so far to say is it's fun. It's fun with you guys. But in some of these, I'm going to get some trolls. I'm going to get some people that are like, oh, nice gaslighting. And I'm like, what are you think my premiums haven't gone up? Like, what do you possibly think that I'm trying to do other than help my clients? Like so.
Yeah. And full disclosure, Whit is a real estate investor herself. We're going to review her portfolio at the end of this call as well, right? So you are just like
my team can chime in, right, about the number of tickets that I have in the reshop pipeline. About we just renewed our office insurance on my office building. I could have gone with a carrier that would have cut the premium in half, but I didn't because I don't want them to come out and inspect it. And I don't want them to make me get a new roof because my roof is kind of border on that building. So like I am right there. I'm right there with you.
Yeah. So going along with the idea of like stuff we talk about a lot on the show, it's, are you partnering with people that win when you win, right? Like the idea that JWB isn't just a property management company, they're real estate investors themselves. That's good for you. The idea that you have somebody who is a savvy real estate investor advocating for you on the insurance partnership side is another plus, right? So you are part of the team here. This is not your fault. You are trying to, help this whole situation. Now tell us all the stuff you want to geek out on the legislation. And then
I know. And I was going to say, and this part is self-serving because the part that's been so rewarding for me is when this stuff passes and my clients are like, we did it. Or when I overhear them talking, did you know that Florida only accounts for 7% of the insurance claims nationwide, but 76% of the lawsuits? That's some bullshit. My agent is working on fixing it. I'm like, yes, that's like the whole thing. Some of these, and I got to give a shout out to Alex Sapakis, one of the owners of JWB. That guy has been so helpful to me over the last few years. He'll put me on these bizarre group texts with these like senators and he's like, hey, Senator, I'm putting my insurance agent on the test or on this text. She knows how to fix this problem. Listen to her. And I'm like, thank you. Here we go.
Alex has a way of opening doors to things that you wouldn't have expected, right?
So, all right. So the biggest thing, part of this bill that's passed is they are doing away with the one-way attorney fee. So this is part of the reason why insurance companies have for fear of going to court, why they've been settling and just paying a claim that they shouldn't pay because they don't want to be in that situation where to avoid paying a $9,000 claim, they get $90,000 in lawsuits. So in this case, now that the one-way attorney fee is gone, there are still some exceptions like medical malpractice that the failing party does have to pay for the prevailing party's legal fees as well. Like there are still some exceptions, but for the most part, this kind of stuff that we're seeing about, my roof, I say, is damaged. My insurance company only wants to give me money for the 6 shingles that are damaged. In those cases, that homeowner has to pay their attorney or their attorney fees are going to come out of their settlement. So all of a sudden now the policyholder has some skin in the game. And I want to take this opportunity to be crystal clear here. I feel fiercely that every insurance company should be paying 100% of the claims they owe. 100%. I don't want them underpaying by a penny. But when they overpay, all that means is that they're charging more on premiums to my clients that don't file claims, or that, I mean, in many of them, we've got clients that have hundreds of homes that don't file claims. And it's wildly unfair for them to have hundreds of thousands of dollars of rate increases because somebody with one house has roof envy and 3 shingles that are missing and they don't understand. That's part of the big issue with this, is they don't understand that this is wrong and that this is a broken system. That's been so normalized that you have really good people that are doing this. And I don't want to say it makes me happy, but I do have a little bit of sense of how the conversation, I don't know, pride, satisfaction, how the conversation has shifted to now when people talk about that they did this a few years ago, there's a little bit of like, I didn't know. I'm sorry. I didn't know what I was doing. And I'm glad that narrative has been changed to really be more fair. So one-way attorney fees, gone. That's the biggest thing that we could have ever hoped and wished for, and it's been put into law. It also changes the contingency fee multiplier and puts us in line with the federal standard, which means that can only be applied for an attorney to make multiples of their typical hourly wage when a case is truly rare and unusual. These are like civil rights cases. These are like the Aaron Brockovich, the big company is poisoning the water, and we need attorneys to take on these important cases that they may work on for many years and not get paid. So if they take on 10 and they only get paid on 1, the fee multiplier is there to incentivize them to take on these important cases. We do not need to be incentivizing billboard attorneys to take on cases to sue their property insurance companies about a roof. Okay. Got it. Moving on.
Public health disasters, big things,
right.
So
now Florida is back in line with the federal standard, which we shouldn't have ever deviated from that. That is a good thing. It changes some things with the statute of limitations. It used to be for 4 years. Now they're shortening that to 2 years. This is a great thing for landlords. The bad faith law, it's well intended. It's, the insurance company has to respond by a certain time. They have to say what they're going to do by certain timelines. The problem is that, there are these opportunistic attorneys that will intentionally set up, they call them a bad faith trap, where they'll time it, where they send it. And if they don't reply on the 30th day, because God forbid somebody's out sick, or they're behind in their emails, and it's more general negligence than it really is truly bad faith. Bad faith is like they're withholding documents because they don't want to pay a claim that they know that they owe. Yep. So it's really changed the guidelines and made it so true bad faith will still be bad faith, but things that are general negligence will be, not treated that way. And that's going to, the result is that's going to be lower court costs for cost of litigation, because we're not litigating on things that we shouldn't be litigating about, lining the pockets of billboard attorneys. Okay. So into the nerve here. This is a good one. There is now a provision of this that is called comparative negligence. So this is where if the plaintiff is more than 51% at fault for a situation, then they can't sue somebody else's insurance company. So real life example that we've seen with a real estate investor, a resident tripped over her own hose, filling up an unauthorized above ground pool in her backyard. And she sued everyone. She sued the homeowner. She sued the property manager. She sued probably the bird that flew over the sky and looked at her cross-eyed that way. And the insurance company did settle because it was cheaper to settle than it was to go on with, just ridiculous. So you hear these kinds of stories. One of the ones that was filed when I was in Tallahassee, one of the agents that I sat with told me about, you hear these like urban myth claims, but this actually happened with her policyholder. A burglar was breaking in and fell off of the balcony and sued her. And so like that kind of stuff, like he fell because he's a burglar and he's outside of a balcony. Like that's not, how is the homeowner negligent in that? So that should remove a lot of this bloat lawsuit stuff as well. That's going to be huge. And then there's some pieces specifically, if anybody's on here that invests in multifamily, there's some nice protection about illegal activity potentially happening at apartments and multifamily, to where, the landlord can only be held so responsible if they're doing the things that they're supposed to be doing. It's well lit, it's, whatever, that there are guardrails now for what they can be sued for, where it used to be, if anything happened, they always, they would sue the landlord. So it's really good stuff, really, really good stuff. And it's going to take, like I said, it's bloat, this tort tax that we've been paying hidden in our premiums for years. It should go really far to reduce that. Now, change takes time. We've got the carriers go for their reinsurance renegotiations January 1 and June 1, and we are still coming off of Ian. So the chatter has been that their talk is Florida, this is great. We love your legislation. We're thrilled about this. We want to continue to play in your sandbox, but show me. Let's see. Like now that this has passed, show us that it's working. And then we're very interested to have a conversation where we can be more aggressive. So,
got it. Epic summary.
I'm going to try
to summarize that as much as possible. I love the term bloat, right? Like the idea that bloat has been taken out of the system, right? Like this, like bloated stuff. Essentially, they took a second look at what was going on and they redefined what is negligence versus malicious actions, which will de-incentivize bad activity, but also not overly punish people for things that aren't as bad as the bad activity. They made it more so the homeowner has a little bit of skin in the game and not just like, well, it's either a lottery ticket or nothing, right? Like if they're wrong about something, they might have to pay a little bit of extra attorney fee that they didn't have to before, so that disincentivizes the. Sounds like I got that part wrong.
Well, they're a little bit separate things. The piece with the one-way attorney fee is it's great. I mean, all of this de-incentivizes frivolous lawsuits. That's the big thing. And there are many ways that we've said, stop bogging down our core systems and extorting our insurance companies for paying all these legal fees. When you see the breakdown of where the money goes, how much we're paying is going to pay for this stuff. We need to get that gone. And if we get that gone, then we're in a situation where we have more carriers that want to do business. We have competition that way. We have years where they may be making money and therefore compete for business, lower their rates. I mean, when I started the agency in 2014, carriers were taking rate decreases. And it's funny to think of, we would write just about every single policy that we would quote just because the market is cyclical and there was always a carrier wanting to buy up market share. And so it was, and now is a different world from that. Sometimes we're having conversations about, let's wait till after hurricane season. Let's wait till your next renewal. Let's see, if it's going to be best for you to stay put or best for you to move. It's definitely not that 100% anymore.
Got it. All right. So I'm just going to simplify with less specific things. They have taken out bloat by taking away the like extraordinarily high things that people would go for that were unfair, taken away like the overly punitive stuff that they were holding insurance companies against, and also taken away the stuff that allowed people to just be complete idiots on somebody else's property and make money, or even on their own property and make money on that, right? So, okay, cool. Whit, I would love to get it. We got a bunch of questions and I want to get to your real estate portfolio. So let's jam. We got Drew Barnhill, ringmaster of the community. He says, can you explain for everybody about DP1? Is that what we've been talking about the whole time? What's DP1?
No, but this is a great topic because this is, when we're talking about what are we going to talk about before the show, the conversations that we have with our clients all the time, it's case by case. This is not blanket advice for all people, but we know that this is the not your average investor show. And, this is not somebody who owns just their primary home and they would be having these same kinds of conversations. But in the real estate investor landlord space, for single family homes, the two most common policy contracts are a DP3 and a DP1. A DP3 is the more comprehensive policy contract. It includes replacement cost. It includes coverage for water damage. There's some other things as well. The DP1 is the more basic, more economic policy. It has claims that are settled on an actual cash value basis, and it doesn't include water damage, but you have the big ones. You have coverage for fire, you have coverage for wind, you have coverage for liability. So if you have somebody on their primary residence, would a DP1 be a good option for them? No, we want to make sure that we get them back to a pre-loss condition. They had, beautiful wood floors. We want to get them beautiful wood floors. We want to make sure that that's covered for water damage if there was a busted water pipe. But a real estate investor, especially ones that have a higher tolerance for risk and that maybe have 5, 10, 15, 20 homes, and can understand, okay, if I'm saving this much per property and I take this risk philosophy on my whole portfolio, then I can afford to pay out of pocket for some of these things because I like it because it's a quantifiable amount. we know, okay, how much roughly is depreciation going to be? If I had a water damage claim, how much is it going to cost me truly to get back to rental standard? If I have my property under property management, they're going to get somebody out there right away. Spoiler alert, I had a water situation. My tenant at one of my properties they broke the faucet, I think, in the kitchen sink. I think they broke off the faucet and they couldn't find the water main, and it was like a whole thing, whatever. So we sent out the water dryout company. We ended up having to replace the kickboards at the bottom of the, around, we have tile in the house. But the point is, when I replaced the kick plates or whatever, we just did back up to rental standard. That was a few $1,000s of damage. I didn't even turn in an insurance claim because I wanted to pay the lowest rates for my insurance in the long run. And for me, it made sense to self-pay those things to save the money on the front end. To save the money on the front end and for many years to come, rather than turning in a small claim and then pay for it, what would I feel like again and again? And that surprises a lot of people because I'm an insurance agent. I want you to have a lot of protection, but I want you to be super covered for the sudden and catastrophic big stuff. And I want our clients to pay as little in premiums as they can for having the coverage that they need, as long as they fully understand every exclusion, they fully understand when they have a claim, what they're giving up in order for making that change. It can be a good option for some people. Absolutely not everybody. We have some clients that are like, nope, I just want to know it's going to be fine. When I have a claim, I just want to know that it's covered. I don't want to think about it. That savings isn't enough for me to give up that risk. Everybody has their own threshold of what they feel is enough savings. But if Kimberly's on the team, is Kimberly on there? Oh, good. Oh, I just thought you had to just put a shout out. Kimberly's been great with this. Great. I was just going to say, no, Kimberly's on the call right now. She was reshopping one of mine and I increased my deductible from $1,000 to $5,000. And the savings wasn't that much. I mean, I want to say it was only like $100 or something. And she was like, are you sure? And I was like, I'm sure, because I'm not putting a claim in for anything under that. And if I do that across all my properties, then it adds up. Everybody has a different threshold where they feel comfortable. For me, it's probably going to be a $40,000, $50,000, $80,000 claim before I turn something in. So why am I paying to have that lower deductible all the time? My philosophy. Not everybody is in that situation. So anyways.
Good explanation, right? So just kind of like weighing the pros and cons of, cash flow today versus cash flow tomorrow, essentially, right?
Right.
Something we talk a lot about, right? Is when do you pay the money? All right. Denny Davis asks, Whit, thanks so much for co-hosting. All right. So this is, with the latest tort reform, will insurance premiums begin to decrease or will they just increase at a slower pace from here forward? I guess this is kind of like, you can't tell the future. And if I'm hearing you correctly, you think that right now we still need the state of Florida is still in this kind of like, prove it to me that we can be responsible with this stuff. And then if it does happen, then they can start coming down. So we're still in like a wait and see, right?
That's exactly what it is. I would love to come on here and be like, it's going to happen, but they say that any legislative changes take about 18 to 24 months to really see the effects of. That's not just this specific one. That's kind of a rule of thumb that you hear thrown around. And we are still seeing the follow-up of claims from Ian. So absolutely. Unfortunately, my answer is we're in wait and see mode, but we are in a far better position than we would have been if we didn't get this big, bad legislation pushed through.
Got it. Great. Anonymous attendee asked the question, now that legislation, this is a tough one, right? Like, so it's basically the idea that rates have gone up like 3x in the last 2 years. Do you think there's any chance that they go down commensurate to that or something else?
So now we're asking, my opinion on
this. Your opinion. Correct.
So, I think that we were in a unique situation before in Northeast Florida. Mm-hmm. And I hate to get in the weeds, but I feel like this anonymous question asker would like me to kind of go there. Mm-hmm. But I think that the rates that we were seeing 5, 8, 10 years ago were superficially low in Northeast Florida, because the more I've learned as the market has changed about reinsurance and what kinds of things a carrier wants to have in their portfolio in order to get preferred terms on their reinsurance, having more business in Northeast Florida really helped them. Similar, having a lot of new construction helps them. That's why new construction premiums are still very competitive, because companies want to buy up market share. So there's not always a straight line connection between what is the true actuarial risk of this house in a vacuum versus how much premium I need to charge. There's an extra layer of, if I can get more market share in this specific niche, if I type of home, or if I can get more market share in this specific region, how does that affect my big picture? So that's a roundabout way of saying, I don't think that they're going to go back to what, where they were for that reason. And also just inflation in general, things cost more, but to that end, at least in my properties, hopefully I'm not, this is an overstatement, but most rent has gone up as well. So that's been something that's offset it. I know that in my portfolio, the rents that we're seeing now were not the rents that we expected to see initially in our original deal evals. So they've kind of adjusted. All of the factors have weighed in there with inflation. It kind of goes both ways.
Got it. So,
but I'll throw a party if they do. Okay.
Yeah. So you're not predicting that they go back down one to those costs, but there is hope that they do go down. And on top of that, when you look at the whole pie, there's also the idea that rents have gone up. Property prices have gone up a lot, right? So that's part of what's holding it back. So the gains will likely still, or the gains can outpace the raised insurance rates, even if they don't go back down 1-to-1.
Correct. But I think that there are also going to be, when you see the stats, if they look at, the average insurance cost in Florida kind of thing, or if the average increase, the average decrease, there are going to be a lot of hidden wins in there that are not going to be accounted for in the additional flexibility of underwriting. So you're going to have someone, just for, easy math, say they were paying $1,000 a year for their insurance, but then their roof aged over whatever arbitrary year it is that moment of the day, where now they're only left with 2 or 3 companies that will write their insurance. And therefore, because their options are so limited, their insurance is 500% rate increase. They're at 5,000. Well, now that we have and again, these are just numbers I'm pulling out of, but now that we have companies that are no longer fearful that they're on the clock for this older roof until door knocking roofer comes along and feeds them into the system that puts them into having to pay this bloat of these frivolous lawsuits, yada, yada. Now, instead of 3 options, you may have 15. And instead of having to pay that, now you can go to another company and have a lower rate. So that's not going to be reported in anything you're going to read in the paper about the rate going down. But the competition, giving people more options, should deliver a similar type of savings, a benefit to property owners in Florida.
Okay, great question. All right, great answer. All right. Alex Diaz from Tampa, Florida asks, hi, I have 8 rentals with JWB, 2 of them with flood insurance with multiple insurance companies. Would it be more cost effective having all under an umbrella policy or all policies under an insurance company?
Oh, I wish. It would be so much less work for my team. Nobody wants that more than me. But, our approach is we invest in the fancy schmancy software. We run every property through all of the carriers that we work with, and we look at the bottom line. There are a couple of companies that do offer a multi-policy discount. When we quote, we always quote with that to give each carrier their best foot forward, their best shot at earning the business. And, different homes are in different areas. They have different attributes. It usually doesn't work out that the same company is going to be the best for all of them right now. That could change in the future. We have seen for the clients that are more risk tolerant, that feel more comfortable with that basic policy form, the actual cash value, and even going a little bit lower. Say the market value of a home is $300,000 and the insurance company is requiring you to put replacement costs at least $250, but you bought it these years ago at $120 and you feel comfortable insuring it at $150. We have those clients are putting them on schedules now. We're having a little bit more success, but most of the time their benefit is the ease of having them all on one, the transactional ease. It's usually not a premium savings at this point. I will let you know absolutely though if that changes.
Okay. All right. Leslie Wilson has a question for Whitney. Will the Florida insurers be depreciating their roof coverage on their replacement cost policies? This is something that Colorado insurance are doing because of the hail claims, where people could defer their maintenance and just wait for a hailstorm so that they could file a claim for a whole new roof.
Yep. Will
The
that be
answer
the
is yes.
shortest answer that I?
Yeah, great. So they will be depreciated.
So elaborating on that, many of the companies are already there on investment properties. They tried 4 times. It was part of the last 4 legislative sessions. That's been a talk in the property insurance market about letting the carriers offer this as an option and give a discount for it. It has not gotten approved on the owner occupied side, but they are letting carriers do it for real estate investors. And I don't know if it's majority of them. I feel like majority of the ones that we're writing are coming back. They call it a roof replacement schedule, which is slightly better for the homeowner than actual cash value, because actual cash value takes condition into consideration. So this is like in the policy contract, this is exactly how much they're paying based on the age only. And big picture is a very good thing, because it's another measure that de-incentivizes insurance claims and the cost of adjusting insurance claims that should never have been insurance claims. You don't turn in an insurance claim on your car insurance when your tires wear out. It really shouldn't be an insurance claim on your roof when your roof wears out. And what we find is all of a sudden, if it's, easy math, it's $20,000 to replace a roof. If it's halfway through that life and you're only going to get 10, all of a sudden it probably has another half of its life, then it will be just fine for if you are if you don't have to come out of pocket, or if you are the one that does have to come out of pocket, rather, for that additional $10,000. So I expect we'll see more of that.
All right, cool. Great question, Leslie, and great answer. All right. Another anonymous attendee. In case of property held under an LLC and mortgage in personal name, is the claim history of the LLC considered for personal when applying for insurance?
So this is carrier by carrier. Some carriers look at both the property address and the applicant, the actual homeowner. And some of them also will look at the signer, the individual who's the managing member of the LLC. Some of them only look at the property. Some of them only look at the person. It really depends. But I would say that it's all relevant. It's something that we ask. We need to know that information. And you heard me mention way back in my history lesson about the Joyce case. We need that information. The worst thing you can do is not tell us about a claim, and we write you with a company whose underwriting guidelines say that somebody is not eligible if they've had a fire claim, and then you have another claim and they say, oh, we're not paying it because you were never eligible to have insurance with our company because you misrepresented yourself and you said you had no claims and you did have a claim. Like, please, please, please don't do that. Fully disclose everything to your insurance agent so that we can make sure to get you set up with a policy that will actually pay when you need it, which is the point of insurance.
Got it. All right. Eddie Harris from Hotlanta asked a question. Obviously Florida has no caps on how much premiums can be raised year over year. Is any of that being addressed in legislation? Or is there anything in legislation?
Oh, it absolutely has caps. Every rate increase that they file has to go to the OIR. It's a huge deal to get rate, is the term that they use in the industry. They've been begging for rate, and the lack of ability to get the actuarially needed rate increases is what contributed to the carriers that went into receivership and went insolvent last year. So it's very regulated. There has been there's a piece that's in discussion right now. The last that I read, it had not been fully articulated or passed, but there is an insurer accountability bill that's in session right now that has to do with, the financials that they need to provide and other layers of transparency, which should be helpful. But there are many layers of consumer protection, of preventing the insurance companies from charging whatever they want. There's an interesting thought on this because, God, bring me some competition. That's what I want. I want, this to be a place where the insurance companies can make money, stay in business, and they want to be here and naturally drive down the premiums for our clients. The lack of competition has been the thing that we've been seeing that's been making the rates go up. So it's, unintended consequence. Again, that's going to be the buzzword.
Gotcha. All right, we're going to do some rapid fire so we can get through this real quick and then go to your portfolio. Leslie's asking, is it true that Florida insurance companies do not like roofs that are older than 10 years old due to code changes? True or false?
It's not the code changes. It's been for the last couple of years, the fact that they're on the clock. They're on the clock on that older roof for when, not if, but when that claim is going to be filed, and they're going to be faced with insuring against the risk of having to litigate.
Got it. JC is asking.
Hopefully there'll be more open. Sorry, I'm dialed in. I'm dialed in.
Rapid fire. JC's asking. These are all Florida specific reforms, right? Yes. Right.
Yes.
All right. Cool. Jonathan Lube is asking. So when can we expect premiums to start coming down? I feel like we answered this before. It's kind of like
we're in wait and see.
It's a wait and see. Once we get past the Hurricane Ian stuff, insurance companies got to just kind of like prove that they can continue to operate well, right? Eddie Harris says, talked with Richie about lowering rates. Can you give us a brief explanation of the different classes of insurance plans? The lower rate is better, but does not expose us to bigger risk. Thanks. I feel like that cannot be a rapid fire question for you.
So that we talked a little bit about the DP1, DP3 conversation, and there's a great resource if you go to our website that has a little chart and a whole blog about the difference between DP1 and DP3. RichieInsuranceGroup.com, click the resources section.
Boom. Let's go. Denny Davis, that answers your question about the typical differences between DP1 and DP3. Anonymous attendee, one of my properties last summer could not be renewed for insurance because the roof was older than 7 years. And we even got a roof inspection that showed tons of years left for it. I refuse to replace a roof for no reason. Are we going to have that kind of problem again this year?
So I feel for you hard. Like I said, with my building that I just went through, we're talking thousands of dollars that I paid to not have to go through, the roof inspection nonsense. And I agree with you completely. Starting the clock on a 7-year-old roof again over the long term it's ridiculous, which is what I've been schlepping over to Tallahassee and complaining about. This is garbage that you're faced with this. So one of the previous viewers, attendees, guests mentioned about the roof replacement schedule, that helps you a lot. Because when a carrier is like, yes, I'll give you insurance, but I'm not on the hook to have to replace the whole thing, that should help quite a bit. If you want to message, ping me or message me your specific address, we can look at that for you. Because as I mentioned, we've gotten a lot more flexibility just in the last month with this passing, and we may be able to help you out with that.
Love that. Shout out to Avianca Manning, who posted the RichieInsuranceGroup.com/resources link in the chat. If you're listening on the podcast, go check that out. Mike Foster asks, Whit, does your company reevaluate insurance costs for JWB clients at each anniversary date?
So we do not have the bandwidth to do it at each anniversary date. I would love that. But what we do is we keep our finger on the pulse of the industry. And when one carrier has a rate increase that's out of line with what we're seeing across the whole industry, we'll pull that book of business and we'll reach out to them. Unfortunately, it just doesn't, there are not enough people and hours in the day for what that would take. But we will absolutely, if somebody reaches out to us directly, do whatever you want. That's a few of the people in the comments have mentioned that they've been working with Kimberly on that. Kimberly's been working with my own on that. And so we're glad to, as requested, to look at anything for you.
All right, cool. I'm not going to bring up the fact that you said do. All right. Anonymous attendee says, could you explain what is involved and the risks of changing insurance carriers? Does it make sense to change? When does it make sense to change?
Mm-hmm. So you have to go through underwriting again. So that means the insurance companies have come out. They're going to look at the home, and they are in this crazy couple of years, they are looking for reasons to not write the business, which is very challenging for us as an insurance agent who's trying to help you. The last thing we want is to find you an option that's going to save you money, and then they come out and say, "Well, you need to trim these trees back, and that's going to cost you $1,000." So, it's on a case by case, but usually if the savings is not that much, if it's only a couple $100, you roll the dice a little bit. Sometimes we feel like it's better to just ride it out and hope for that the stuff will be, the broken system will be fixed in the meantime.
Cool. Great answer. Last question. Stephen Smith says, then how often would you recommend shopping insurance? Every 3 years or so?
It really depends. Right now, it's depends on how much the premium increases over the prior year. Depends on what your budget is. Depends on how underwriting friendly your property is. The best answer I would just say is have a relationship with your agent where you feel comfortable to reach out and say, is this a good time for us to look? I will say that there are analytics. I mean, this is a little bit more on the auto side, but there's an underwriting cost in acquiring a new client, and they can actuarially figure that out. So when they look at your client score, you'll see people, again, it's very clear on the auto side, people that change auto carriers every 6 months because they're always shopping, they end up paying twice as much because the carrier knows, well, if they're going to come, they're only going to be here for 6 months. We're not going to recoup the onboarding cost. So I don't think it's a good thing to do with super regularity if you end up paying more in the long run. But if you have a rate increase that's out of line with the rest of what's going on with the industry, then reach out.
Got it. Denny Davis says, can we have Whit back once every 6 months for an update? This has been phenomenal. I agree, Denny. I love having Whit on. Whit, are you ready to see this is your life journey of real estate investing? I
didn't know we were going to do this. Let's see it.
Are you cool with it? All right, let's go.
Here we go. Oh, there I go.
So here's Whitney dressed as she normally is dressed. She cut off her sleeves for this one today, but she normally has sleeves. All right. This is your history of purchases, right? So you started in 2020 buying these turnkey rental properties. And I think I remember having Rich, your husband, on when he said the deal is in the debt in 2020 and that he was going to act real quick. And y'all went out and bought a whole bunch of properties.
It was a weird year. That was a crazy year.
2020 was a weird year? You don't say. So you bought a bunch of properties in just under 2 years. Looks like most of them financed, one cash. What was the decision behind doing a cash one?
I was part of a 1031 and no one would lend me any money after that.
Okay. Got it. So then this is your best performing so far. 23% returns here on, move this up, annualized returns without including appreciation or anything like that. Seems like a really nice experience for this. Anything in particular that you knew about Coco that was going to make this thing happen?
No, but we insure a lot of JWB clients that are on that street. The team can attest for this. Every time I see a Coco address, I'm like, that's my star. I've got a house on Coco.
There you go. And then this is the lowest returning home on expectation, 2957 Gilmore Street. Anything, this is obviously one of the more recent ones. Anything happened in here that you remember that was like a bad experience or anything like that?
It wasn't a bad experience, but that one, and we knew we were on the 1031 clock. We had to move quickly, and we bought this one at the height of when the real estate market, all the prices were the highest. And so, we kind of knew that was going to be probably the case. I didn't know this. This is the first time I'm seeing it like range like this, mm-hmm. But we made the informed decision that when we purchased that the savings on the tax consequences with the 1031 would still be a good deal for us, even if it didn't deliver us Coco returns.
Cool. Great insights. Sergio Prieto, a fellow Gator, says we're your neighbors in Coco also. All right, wait. So this is the overall portfolio performance review. Total net rental income since 2020 to now, $83,467. Total tax savings, $9,805. Total principal pay down of 35 and a half here. And look at this home price appreciation in just since 2020 of almost $400,000. How's that look to see that?
I'll take that. I'll take that. Great. Thank you.
Pretty awesome. Hey, and I'll
I'll pause to put a plug in here. I mean, I tell everybody, because you know me personally, but I run a business that I started with. It was just me, built the team out. We have 23 people. We have, including the people that are going to be starting on the team. I've got 3 kids, including twins, and we are busy as anything. And there is absolutely no way that I could have bought all these houses if I didn't if you didn't send me a spreadsheet and say, pick one. And all I had to do was sign the paperwork. And occasionally I get emails from Maddie that's like, okay, the resident would like a fence. They're really nice. Is that going to be okay? And I'm like, yes, do it. Or like whatever the thing is, that's the only amount of time I have to be a real estate investor. So it's a beautiful thing about the JWB model that I get to participate and have these benefits for my family and our future retirement. And it's a really big deal to us that we would never have been able to do without JWB's help and support. So thank you. Oh my God, your name is Bob Flo. How did I not notice this?
That was Billy Green figured that one out. All right.
Oh,
so
Lord.
Yeah, so totally passive. Agreed. How many houses is it that y'all have with JWB? I didn't count them in there in the beginning. Bunch. Well, we can always go back.
You're going to embarrass me so I'm not sure how you count them.
1, 2, 3, 4, 5, 6, 7. So you got 7 properties with JWB. We just went over
that. They also manage one for us that we had before when you guys weren't.
That's right.
When they weren't taking outside owners that they do also.
That's right. And for these 7 homes, your expected ROI was 9.9% till now. Your actual ROI is 16.8%. So pretty nice little beating expectations. And then we also like to go over this whole per profit center breakdown, right? In your 7 homes, this is really eye-opening for people, right? Because everybody obsesses over rental income. But generally, when you look at the breakdown of profit centers per portfolio, you see that rental income, 15.8%, not too bad. Mm-hmm. You got a pretty wide open mouth Pac-Man here with tax savings and principal paid down making up the mouth, but always the Pac-Man itself, the glut of the return is this 75.6% of the whole return is this home price appreciation. So we like to show people that. That was awesome. I love contenting with you.
No. What do we say? Wait, am I allowed to curse on this show? Or are they going to kick me out?
I mean, it's all about who you know.
Shooting the...
What? This was awesome. We had 110 people on. So people wanted to hear this. You showed up, you delivered the goods. They've asked you for an encore, which is no surprise. We still had like almost 100 people 5 seconds ago, right before we started saying that the show is over, but a true value of, your knowledge base, you fighting for us in Tallahassee, being on the inside, in the real estate space and in the insurance world. Just really, really awesome. And I love doing this with you. And we wouldn't be able to do it without the whole community who asked for the show, right? Like when you ask for something, you make it clear you want it, we make it happen. So I just love having the community here, that you took an hour of your day in the middle of a Thursday to hang out with us the whole time. Really means the world to us, and hope you keep coming back. Whitney.
You guys are the best. You're the best. Thank you. And thank you so much to everybody that tuned in. I'm really kind of overwhelmed. I'm really, really grateful. This was great. And like I said, I think Avi put the link to how to contact us. We're at Ricci Insurance Group on all social media. If you want to follow us there, we put a lot of this stuff on there. So if you want to be kept in the loop between now and the 6 months, I think that somebody's put dibs on me coming back in 6 months. If you want to know what happens between now and then, that's where you can find it.
Wait, is it true that there's a webinar series coming from Ricci Insurance anytime soon? Is that maybe in the works?
Yeah, the rumor has it. Yes. So, but we're calling it a podcast. I told you, because that's cooler.
It's cooler. It is cooler.
So we are gonna launch. It's coming soon. So you guys, this is actually the first time we've talked about it in a public setting, but we have a lot of information to get out there, and our clients are asking for it. And so we are going to put together a series of videos. We're going to call it a podcast because we've been told that webinar sounds like homework, and something that people are obligated to go to. And podcast sounds cool and fun.
A show is cool.
Show. Okay, we're starting a show. But yeah, a fun little edge to it is my daughter Scarlett is going to help me with it. So we're going to take very complicated insurance concepts and explain them on a 10-year-old level. So
you do not want to play Are You Smarter Than a 10-year-old with Scarlett?
Not with Scarlett. She is
10 times smarter than the average 10-year-old. Wait, that's super cool. I love to hear it. I'm going to tune in. Like I said, I think you're an awesome storyteller. I think you're really knowledgeable on this stuff. I love the fact that you are one of my entrepreneur role models, right? So like I go to you for insurance advice, real estate advice, and business advice. So thank you for doing this. Love you to pieces. And what they say is, if you want to have success like Whit and do this type of stuff, you can't be average. See you on the next show.